morning. It's a great honor to be able to speak here at 3686. And I'd like to kick things off with a brief state of the industry summary, if you will. Our firm has a very analytical approach to selecting VC investments. And one of the byproducts of this is that we've built a very large data set of U.S. venture capital outcomes and activity. And the research that I'm about to show you is derived from that data set. Having a little trouble with the clicker here. There we go. So overall, the news on the industry is very good. Venture returns are up significantly over the last decade, both in terms of the mean or the average, and also the 90th percentile, which we would categorize as the winners. From 2005 to 2013, really the first 9 years here, mean returns improved about 2.5x. So one note of caution, though, over the past year, we actually saw returns decline slightly. And we'll get into some of the reasons behind that later on in the presentation. So now let's look at the drivers that drove these improvements in returns over the last decade. So the first driver is just the aggregate size of the outcomes. How big were the exits in U.S. venture? And this chart really shows two different data points. One is the median, which is the blue line, and also the column on the left. And the other is the 90th percentile. So again, the winners, which is in the green and also on the right scale. So all figures are in real dollars, not to get too technical, but we've effectively taken inflation out of the equation in this analysis. And the first thing that stands out is the overall magnitude of the exits in U.S. venture improved dramatically. For instance, since the recession ended in 2008, about 2.7x. So the wins are just bigger, frankly, in U.S. venture. And here I'm focusing on the green line, which is the 90th percentile. It's the big outcomes that drive returns in the industry. So the next driver to focus on is pre-money valuation. What kind of pricing do we get into companies at? And here I'd suggest focusing on the blue line, which is the median, right? So median being the 50th percentile, the midpoint of the industry. And surprisingly, on companies that exited over the past decade, there'd been virtually no change in the prices that VCs had paid going in. And again, this had a profound impact on the magnitude of the returns, as we saw in the first slide. So the final driver that we looked at was capital efficiency. From 2005 to 2013, the median required to get a company to an outcome declined to just over half, so about 57% of what it had been. This increase in capital efficiency is really dramatic and reflects what we've seen in the ecosystem. So when I think back to when I became a VC back in 1997, companies, and I'm sure my colleagues here have seen this, companies would raise $30 million rounds, and most of the capital would go into servers that would have air conditioning blowing on them. Today, we don't need to do that. So what used to be a fixed cost can effectively be almost entirely variable in your business model. So you can go to AWS and you can dial up your processing as needed. So net-net, the industry has become much more capital efficient. Now, one word of caution, for exits which occurred last year in 2014, we did see a decrease in the underlying capital efficiency, which is the slight blip that you'll see in the blue line there. So now, moving from the companies that exited and what the drivers of those returns were to metrics on rounds that we're seeing going on right now. Looking at two things, pricing and capital efficiency. Over the past 5 years, we've seen pre-money values and round sizes increase. And actually, as you can see on the chart, pretty significantly in terms of median pre-money value in 2014. So while pricing has been increasing in new financings, the majority of the impact has been in B rounds and later. So basically the green line. Seed and A rounds through 2014 had not been significantly impacted by the price increase. So another measure of health in our industry is whether it's generating more cash than it's investing. And this chart shows cash going into VC-backed companies, which is the red bar, and cash coming out, the blue bars. Over the past 4 years, the industry has become significantly cash flow positive. And again, as a brief note of caution, last year we saw the capital invested go up about 50% year over year, as you can see on the right-hand side of the chart. So another driver of venture returns is how much capital is being raised by VC firms themselves. And in 2000, really the left-hand side of the chart, you can see that the industry raised a record $106 billion. And this resulting capital overhang impacted returns for years thereafter. With fundraising returning to more sustainable levels, on the right-hand side of the chart, post-bubble, returns have improved as we saw on the first slides. So this slide shows returns by subsector. And we showed the slide to our limited partners at our recent annual meeting. And we asked them this question, what's the pattern here? The answer is there appears to be no pattern. And no one segment has outperformed over the last decade. And a segment like consumer services, and I know it's a little hard to see, which is the light blue line, can lead the country and lead the pack 1 year and be down near the bottom of the pack the next. So this is one of the reasons our firm invests across a very diverse set of sectors. So another thing we looked at was returns by region. So we analyzed returns for VC-backed companies headquartered in the states with the blue dots, the West Coast, versus the states with the red dots, the East Coast. So let me see a show of hands. Who thinks the East Coast companies outperformed over the last decade? There we go. And who thinks the West Coast companies outperformed over the last decade? Okay. Yes, the West outperformed. But in terms of average returns in 90th percentile, not dramatically. And actually, although not seen on this chart, because this chart shows the decade up to 2014, in the decade ending 2012, the numbers were almost identical, which was really a remarkable view of capital efficiency and capital going to where the returns are in our industry. So although the returns were similar, the East Coast and West Coast companies got there in a different way. So the West Coast companies had higher magnitude outcomes overall, just bigger exits. The Twitters, the Oculuses, the Facebooks, et cetera. And the East Coast, on the other hand, had lower pre-money values, so better valuations, and were generally more capital efficient. So very similar outcomes, different path to getting there. So Charlie and Jill, who helped organize the conference, asked me also to look at the Southeast. And we examined returns over the past decade for venture-backed companies headquartered in the 9 states with green dots, and also the District of Columbia, so a 10th jurisdiction or region. And we compared them to both the West Coast and the East Coast. So the bottom line is that during the past decade, returns for VC-backed companies in the West exceeded both the East and the Southeast. However, there's some very good news for the Southeast. So when we look at returns year over year by region, no one geography has generated persistently higher returns. And the Southeast returns led the country in 2005. They also led the East Coast in 2011, and although kind of hard to see on the graph, also in 2014. So again, this speaks to a strategy of diversifying your risk by investing across the country, not just in one region. So venture capital is a hits-driven business. Over the last decade, about 10% of the financings, which are shown on the chart colloquially as the winners, generate a 5x outcome or greater, and about 65%, the left bar, lost money. So about 0.4% of the financings generate a 50x return. And about 0.1% of the dollars, although not shown on this chart, but about 0.1% of the dollars generate a 50x return, showing that the winners are very capital efficient. So that being said, there's still a lot of winners in US venture in absolute terms. And our firm did a research piece to try to quantify that. And what we have here are 4 definitions of winners. So going from the left, first category of winner, one of the VCs generate at least a 5x return. Second category, one of the VCs generated at least a 10x outcome. Third, at least one of the VCs, maybe more, generate a $50 million gain or a $100 million gain. So when you look at these numbers, it may be a little hard to see from the back, and we divide them by 10 because they're a decade-long figures. It's about 82 5Xs, about 29 10Xs in a given year, about 45 $50 million gains, or companies that exited generate a $50 million gain for one of the VCs, and about 19 $100 million outcomes. So if we look at these statistics now year over year, the picture is even more optimistic, frankly. Since 2008, when we came out of the recession, the number of winners has grown significantly. So the 2008 recession is that dip in the middle of the chart. One measure I like to look at of winners is the companies where at least one of the VCs generate a $50 million profit. And the numbers are very optimistic here. So in the last 2 years that we looked at in a study, there are almost 80 companies that generate a $50 million gain for at least one of the VCs when they exited in each of those years. So again, although it's a hits-driven business, there still are a lot of winners in terms of the number of outcomes. So while the larger share of winners over the past decade was in IT rather than in healthcare, one thing that was very interesting on this chart was that healthcare companies, by each of the measures, actually had a higher probability of being a winner by all 4 measures. So again, speaking to a strategy of diversifying your investment risk by sector. So very quickly, I hope that update was helpful and it provides a platform for our discussion on the VC panel here. But let me give you a quick summary on our firm. At Correlation, we're investing out of a $166 million fund. My co-founder, David Coates, and I were lead VCs at other firms. Over about a 17-year stretch, we've been in the industry now, and we were entrepreneurs before that. And we came to the conclusion that it was way too difficult for entrepreneurs to finish rounds once they had chosen their lead. So we built Correlation to provide a very fast and low-hassle way to finish a round using analytics. Our partner, Anu Pathria, leads our analytics team. He's the inventor of Falcon, which is a leading fraud detection product used worldwide in the credit card industry. And my partner, Grace Chu-Miller, was CFO at Dahl Capital Management for about 8 years and has been with us for about 8 years, so about 16-year VC in her own right. So our firm has made about 105 portfolio company investments, diverse by sector, stage, geography, and the lead VCs whom we co-invest with, about 140 at this point. And We're differentiated in two key things. One, we're the most active co-investor in U.S. venture for companies that have at least one outside VC either leading the round or participating for the first time in the round in the company. And we can consider investments in any sector, in any stage, in any U.S. headquarters geography, and with a wide range of VC co-investors. We make all decisions in 2 weeks or less. We don't repeat the classic diligence that another excellent firm has already done. We always validate that's been done in that round, but we don't repeat it. We only ask the team for 5 documents to populate our algorithm. We don't take board seats, we don't renegotiate the terms, and we're very predictable in follow-ons. Second, we use predictive analytics to make our investment decisions. We've constructed this industry-leading database that we showed you some insights from today, which comprises about 98% of all venture financings over the last 24, 25 years. And from this data set, we've invested in an investment algorithm, which we use to make very fast and objective and unemotional decisions. So, and at this point, we've invested with a very wide range of US VCs, including many of the large firms like Axel, Kleiner, Sequoia, Northbridge, and also many excellent small firms. So, anyway, thank you.
Thank you very much.
Yeah.
So we're going to move into a very fun panel because often it is the VC asking questions of the startup, and we are going to ask questions of the VCs this morning. So make sure you get yours lined up. If there's something you want to ask towards the end, we'll have time for some questions from the audience. So we've gotten an introduction from Trevor, so he's one of our panel members, and we're going to move down the couch and get some other introductions, and then I'm going to ask some questions. So we'll start off.
Thanks, Eric. I'm Paul Santinelli from Northbridge. Set today's venue is amazing, and the energy here is pretty wild. It's a lot of fun to be up here and sit out in the audience and talk to you guys.
My name is Robert Hatta. I'm a partner at Drive Capital. We're based in Columbus, Ohio, and focused broadly on investing in technology companies across the Midwestern United States. We're about a 2-year-old fund and have so far invested in about 15 companies at varying stages from product in the market, just a few customers, perhaps no revenue, all the way up to growing and making progress towards becoming a massive business.
How you doing? I'm David Hall from Revolution Ventures in Washington, D.C. We are a $200 million fund focused mostly on early stage deals, typically not a seed deal, but mostly sort of a Series A is where we kind of is our sweet spot. We invest in both consumer and enterprise businesses, but really love businesses that are leveraging technology to transform mostly staid and slow growth industries where there's lots of margin. Love Nashville, have been here a lot. My genesis is in Nashville. My parents met here, so in a way I was sort of, my start is in Nashville as well, so glad to be back.
That's great. So let's start off with like the logical thing. So Trevor just presented a bunch of information about things that they're seeing, trends. What stuck out for you? What was something that really either resonated or maybe you would take a little bit of an exception?
Well, I thought, first, thanks for doing all that work. It's phenomenal work. It makes me feel good to be a VC based on some of the slides that you're given. One of the things that struck me was how the conservatism that you find on the East Coast as it relates to investors with typically sort of lower pre-money and a little bit more capital efficient is a phenomenon that we see a lot in our deals. We look most places but prefer not to necessarily invest in Silicon Valley. And as a result, when we talk to entrepreneurs, I'm like, oh, you guys are East Coast entrepreneurs. We'll come back when we have $1 million in revenue. But you're seeing some of the data sort of support that notion of conservatism, and it's a little refreshing to see it sort of validated by results. But we're still we still drive towards ideas as well.
Yeah. Robert or Paul?
Yeah, so a lot of points that Trevor made were around increased capital efficiency, in many cases driven by the rise of cloud infrastructure and the decreased cost of building and maintaining what used to be a data center in a lot of businesses. What that's also done and what we've benefited from is it's untethered businesses' needs to be in Silicon Valley or Seattle. It used to be when you were a business of scale, you needed what was originally a server closet and then a data center, and you needed all the talent to stand up and manage and scale not only that infrastructure, but all of the close to the iron applications that sat on top of it. And those are still very highly geographically concentrated skill sets in the Bay Area and Seattle. Now that you can rent that with a credit card on Amazon, you can build your business wherever you want and build a business of scale wherever you want. And our thesis is built on the idea that if your business sells to or is reliant on talent from certain industries like health insurance or healthcare or manufacturing or agriculture or retail, or the other sorts of huge industries with big problems that technology can solve, you're looking at clusters, in our case, around the Midwest. Manufacturing is increasingly clustered in the southeast. So now you're no longer tethered to the Midwest, tethered to the West Coast because of that infrastructure, as well as the cost benefits that come with it.
I would say that there's kind of three things that I got out of it. Number one, don't believe the West Coast hype. Everybody thinks that, there's a gold rush. The failure rates in California are significantly higher. Not only the number of failures, but the amount of capital that gets washed down the drain because everybody is chasing a deal up Sand Hill Road that they need to get into. The second thing that was interesting is if you looked in the 2000 timeframe vintage funds, the amount of capital, $106 billion that went into venture. Now we're down into, what was the number?
I think 30 last year.
Yeah, 30 or 36 billion in venture. The interesting piece is the number that wasn't up there was how much capital was committed in 2014 to new venture investments, which is higher than the number of capital, the amount of capital that was raised for venture last year.
Correct.
So there's going to be a deficit at some point where there's not enough venture capital going into these deals that everybody's chasing. The animal looks like a horse with the big horn that comes out. Eventually, these things are going to hit a wall. So I would say have passion in what you're doing. Don't pay a whole lot of attention to what's going on the West Coast and believe in your businesses.
So I do have a question. There were red dots and blue dots, and I was going to say green dots, but they ended up being green dots. So where are the purple dots, the Midwest dots? How about?
Well, I didn't see those dots either, and I wasn't sure which color we would choose if we had the option. But we broadly consider the Midwest to be Kansas City to the west, Pittsburgh to the east, up to Minneapolis, and down to St. Louis. We've actually invested in and looked at several companies in the Louisville area, which could be considered south. But I think the bigger theme is not Midwest versus Southeast versus East Coast, but I think anywhere outside of the West Coast, businesses can be built and capital can be successfully deployed. Our idea behind Drive Capital didn't start with the founding of Drive Capital. It actually started 10 years ago when two of my partners were at Sequoia Capital in California, and they made a decision at that point, or made the observation that for the past 30 years, 90% of the market capital in technology have been built inside of Silicon Valley. Over the next 10, 90% is going to be built outside of Silicon Valley. And what you saw were funds open up, Israeli funds, Indian funds, South American funds, Eastern European funds, to find that new frontier where that market cap was going to be built. And you've seen massive successes come out of China more recently, but also in India and South America. For some reason, they overlooked both the Southeast and the Midwest. Midwest, I don't know the numbers behind the Southeast, but the Midwest is the 5th largest economy in the world. And we speak the same language, and we use the same currency, and we have the same legal system, and we're largely in the same time zone, except for Texas. They're their own beast down there. But the point being, there are lots of great ways to deploy your capital outside of the traditional Silicon Valley concentration. For whatever reason, these portions of the U.S. were overlooked, and we think that now is the time to take advantage of that.
So I'm going to change the topic a little bit and talk about the changing role of the VC. So it was interesting that you talked about 97 and the $30 million and what the VC did. And I was in a startup at that point and remember, explaining how we were spending the money. We were building a data center in Atlanta, so maybe, talk about that later. But the VC role, there's a lot of writing about what the VCs are doing, where they play, are they a little bit of a place to work? Do they do this team building thing? I had a startup last week that called me and said that they thought they were pitching an investor, and when they got there, the investor was pitching them, like coming to their center to start working and trying to build staff. What do you see the role of the VC today? How does the VC work? Let's start with Trevor.
Well, again, I would distinguish what our firm does from traditional lead, like my colleagues here on the dais. And we try to do things that are very complementary to the syndicate as it already exists. So our policy is we can be as active or inactive as the team wants, right? There's generally already another lead from our class of stock or our round who's taken a board seat. If the team feels as though they can run without any assistance, we're perfectly happy to participate that way. If they want us to be very hands-on in ways that are traditional to where VCs typically help, introductions, both to new investors, to people that they might want to hire for the team, introductions to potential customers, et cetera, we can do that, right? On the other hand, there are areas that we're very good at that are unique, right? One of the things we've built is this large data set of venture capital outcomes, and we've created what we call the VC matching tool on top of that, which tries to predict empirically which individual VC partner or partners would want to lead the next round in the company. So this is something we've created. It's a fairly crude algorithm, but remarkably effective, right? Just based on sector, stage, geographic focus. Here's a list of, say, 20 VC partners in reverse order that we think are most likely to want to lead your next round. So again, we'll make introductions as you would like to that group, but it's a starting point, right? And additionally, in our case, predictive analytics is an area that we're practitioners in, and an area that's becoming increasingly important in many businesses. So we try to lend assistance that's very targeted in that area, both from Anu Pathri, our analytics head, and other team members to help with that strategy, even hiring in that area.
Yeah, so do you guys have any, David? Is there some different role that you guys play when working with your companies?
Yeah, so I'll start by saying raising money is hard, right? And
Raising money is hard, yes.
And I think entrepreneurs need to be as honest about their options as possible. So sure, it'd be great to have the VC that's the full service VC that provides everything from HR to PR.
Well, is that? I mean, you think that's the right to have the VC that does the full service?
If that meets with your needs as an entrepreneur, sure. And your needs as a business, and sort of perhaps sometimes your geographic positioning, that would be gravy. But the reality is you've got to take the money from the funds that lean in and are excited about you as the entrepreneur, excited about your idea and the market opportunity that you're chasing. I mean, how we think about it is, we're based in Washington D.C., and a lot of the businesses that you're seeing, from Uber to Airbnb, a lot of other industries were a generation ago sort of investing into white space. Like, there was nothing, when people were buying books online, there was no regulation, there was no anything. Now all of these companies are being chased by regulators, and the regulators live in Washington. And it's one of the things that we consider to be one of our core competencies, of knowing how regulation will potentially impact markets. But that's a benefit of our sort of positioning, but also sort of how we've grown up. I think that there are other logical extensions from other VC funds that can sort of help entrepreneurs take a deeper look at sort of what their needs are, and sort of meet them and match them with sort of the VCs and the VC's expertise. I mean, Trevor's point is so well taken that there are lots of expertise that can be shared, but it's very individual, and the matching algorithm, I think, is really important. You can either do the eHarmony model like Trevor, or the sort of old school model like a lot of us, sort of just you fall in love with the company as you see it, and you start to match your needs against their aspirations.
So the importance of subject matter expertise and maybe regional, thinking about that as a regional focus potentially.
Yeah, I mean, I think it's important. I think that one of the reasons why I think Silicon Valley is so efficient is you have that 360-degree. If you're at the Giants game or at a dinner someplace, you can make those networking opportunities happen very magically. But when you're investing across the country, it's harder to sort of create some of that magic where business deals get done, where introductions happen.
I'm probably the curmudgeon in this group. The 360 thing, how well did it work out for the music industry? Not very well. Its 360 view of venture is the pet rock of this vintage of funds. Everybody's trying to create services so they can help their companies. There are two types of venture capitalists in the world. There are those who came out of a finance background, went to a great undergrad, spent 2 years in iBanking, did 2 years of business school, and voila, they're a venture capitalist. And then there's the venture capitalists in the world that started as operating executives. They worked their way up through companies. They were product managers, they were engineers, they were VPs of marketing, they were CTOs, they were CEOs, built companies, and now they're in a venture role where you can get the best out of them by figuring out what you need. If you're purely looking for a check, find the finance guy who you're going to impress with a great slide set, take his check and never speak to him again because he's not going to provide a whole lot of value other than the money. And that's the God's honest truth. If you actually need somebody to help build the business, interview the venture guys who've actually sat in your seat and have been kicked in the face while they've been raising money. They're more than likely going to be able to help you.
So, I'm from Atlanta, and there's probably 1,200, 1,500 startups in the space, and there's startup pitch events all the time. You could probably go one every night. We have Shark Tank, which is kind of glorified the concept of pitching. What's the advice to the startup, the entrepreneur? Do you pitch or do you build your business? And when do you decide when you do that? Because it's really it's a full-time job if you decide to start pitching and trying to get money. How do they make the decision to go out and talk to one of you guys and try to raise money?
I'll jump on that grenade. I think that's kind of a tough question to answer in an event where a lot of people are working really hard and sticking their necks out and pitching their businesses. I think the cop-out answer, but the true answer is you got to do both. And that sucks, and that's hard to build a business as well as raise money, raise awareness, get buy-in. The truth is, you're always selling your business, whether you're raising money or selling to customers or trying to recruit somebody to quit their better paying, more secure job to join your startup and buy into your wacky vision. So the idea that you're building your business, ... or you're pitching is, I think, inaccurate in that you're doing both all the time. Now, do pitch events help? Well, they're a nice aggregator, but if that's the only place you're talking about your business, then you're doing it wrong. Pitch events are any opportunity you have to talk to someone, share your vision, articulate what you're trying to build, and get them to, in some way or fashion, invest in you. Whether it's share with a friend the idea you're building in a way that gets you a new customer, or one that gets you a new employee, or one that gets you an investor. I think it's really hard to separate the two.
So always be selling.
ABC.
Always be closing.
Always be closing. There's good news and there's bad news. The good news is there are a ton of ways to get capital into your business today. I heard a pitch this morning about social capital and the ability to raise and Kickstarter and having, much more of a social environment and socially friendly environment for funding. Venture capital has a return expectation of at least 3.5x. So if they're putting money into your business and they give you $1 million, they're expecting to get $3.5 million in a reasonable amount of time, which is somewhere under 7 years at the current rate. If you can't get that kind of a return, they're usually not interested. The second piece is most venture guys aren't interested in a $3.5 million return on $1 million in because it doesn't move the needle in their fund. So as you're thinking about raising capital, it's the ideas that, I'm sure you heard this 1,000 times. Think big. It has to be a huge idea. No, it takes really 3 things. It takes disruption, it takes a huge market opportunity, and it takes a great product. And the huge market opportunity is what generates the great returns. If you don't believe that you have a huge market opportunity, but you have passion in what you're doing and you love what you're doing, don't talk to venture guys. Do the social aspect. Raise friends and family capital, find local angels, take that money in. Those terms are going to be very favorable, and you're not going to be pushed for an exit.
And I've heard the theory of using some of those social capital ways of seeing if the idea is a good idea. So if you can go out and you can get Kickstarter money, you can raise money from other people, then that's almost a vetting, an initial vetting. What do you think of that as a concept?
It's an interesting indicator. I mean, I've bought a lot of Kickstarter projects just because I love the entrepreneurs. I thought they were great. They had a lot of passion in what they were doing. So, you know, giving them some money to actually generate that kickstart separate of my venture business it's much more of a, you know, the socially correct thing to do. Like, hey, you love these people, you think they're gonna have great ideas somewhere down the line. This may not be the one that's the earth shatterer, but you really want to support them because they have passion in what they're doing. I don't think it's a great indicator as to whether it's ready for venture capital or not.
Everyone agree? Pretty good? Okay. And so we'll talk a little bit about staffing, and we talked about different regions and being able to build the right team. So how do you fill gaps in specific areas? Is it virtual? Like, what is the way that you get the team in place? And is that the most important part to make sure the company is successful?
Yeah, sure. I mean, I think one of the things that we're seeing, and I think a lot of cities like Nashville, like Atlanta, you know, have built pretty efficient ecosystems for hiring sort of junior managers. I think that one of the challenges is the senior level management still predominantly, I would say, in my opinion, lives on the coasts, and recruiting the C-suite into cities like Washington or Nashville are I think a little bit harder to do, especially when a company starts to hit its sort of BC rounds of financing and really needs that sort of next level of management acumen. But I think that the early stage, the really important part of the company's growth, where it's set on the right trajectory, I think most of those roles can be filled locally, and I think you can perhaps even hire up into some of those roles because you're finding people who want to move to the city or want a sort of change of life or don't want, you know, I saw a deck once where the recruiting slide for engineers was a picture of a backyard birthday party because it said, try to afford this in San Francisco, it'll never happen. And I think that there's some merit to that.
So I think the biggest misconceptions about building companies outside of Silicon Valley are around talent. I can tell you that in our experience, we've been able to build great teams around our companies. Build engineering teams full of high-quality software developers, enterprise salespeople, on up the stack. And the last place on the planet I would want to build a team today geographically would be Silicon Valley. The costs, so all these decreasing cost of data infrastructure and standing up a product have been replaced with soaring real estate and talent cost. There was actually a report, and I forget the source, where it showed inverse lines where the cost of building companies from a people and real estate standpoint had completely eroded the gains in savings from infrastructure. So it's actually more expensive to scale a company in San Francisco today, and it is a freaking bloodbath for talent right now, an absolute bloodbath. And I'm always reminded of the story from Scott Dorsey, who built ExactTarget, which Salesforce bought for almost $3 billion a couple years ago, in Indianapolis. And when asked how he beat many better funded Silicon Valley-based competitors, he said two things. The first thing is, I built my company next to my customers, so that when I wanted to visit my companies and find out what our customers and find out what they needed, I'd take my engineering team, and it wouldn't cost a whole day on either side of travel. And they could run back to the office and work on the new features and solutions that they had just heard from their customers that day. And the second thing is, the engineers that wrote my first line of code are in my company today, 10 years later. And that doesn't happen in Silicon Valley. The continuity, the trust, the institutional knowledge that comes over years and accumulates is completely lost on Silicon Valley firms these days, because there's this expectation that if your company isn't soaring like a rocket ship, that every 12 to 18 months you're looking out the window for the next best opportunity. And that's just not a problem when you're outside of that region.
I think Trevor wants to respond.
So I never thought I'd be put in the position of defending Silicon Valley. So let me give you the counter argument. Now, I'll caveat that our firm has investments coast to coast, 105 companies. We're in almost every major venture center. We have a portfolio company here in Nashville, Ito Interactive. have companies in Virginia and in Atlanta, for instance. That being said, one of the things about Silicon Valley that's so amazing is that we have repeat entrepreneurs that have had wins before. And I guess what we're increasingly seeing is people are using the runway that they've generated from their last win to be able to seed and start companies in a very capital efficient manner. When you pair that with, say, AngelList and other efficient ways to raise capital, albeit in small amounts, we see people get started and run 2 years off of $1 million or $2 million. And a lot of the talent is coming off their last win. In some cases, they're actually cohabitating with the company that acquired them or the last company they were at that went public, and keeping the real estate costs very low. So no, we're big fans of the Southeast and investing outside of the Valley, but I do want to point out just the incredible benefits of the Valley as well.
Hey guys, I want to jump in here real quick. I'm out here in the audience. We want to open it up for some Q&A. How does that sound?
That sounds awesome.
That's great.
I want to go ahead and start because I have a question about Silicon Valley. I've been watching this amazing documentary
Don't say it.
of a startup on HBO. The show's called Silicon Valley, and it just seems like it seems hyper real. Does any of that show just kind of drive a dagger straight through your heart?
Actually, every time I watch it, I just shake my head. It's about as close to reality as you can find.
Which way are you shaking your head? This way?
No, this way.
Oh, okay.
There are a lot of similarities in that show to what actually happens in the Valley. I don't agree with Trevor on the Silicon Valley's an amazing place because, for $1 million or $2 you can get enough runway. I think you could do that with 3 people who've been at the same company and worked with each other, and they're willing to take a small salary while hanging out and cohabitating. Most of them don't want to do that. They want to be paid top dollar. So, 2 interesting parallels to that are all the stuff you see in the Palo Alto rental house. We're all going to hang out. There aren't a whole lot of Palo Alto rentals. And if they are, they're about $15,000 a month. Secondly, these engineers that are all, working for sweat equity, good luck. You don't find them anymore. We found the average cost to be about $190,000 a year for an engineer with 3+ years experience. In both cases, I have 2 San Francisco companies that have moved their engineering staff to either Austin or Cambridge, Massachusetts, where they're paying about 70%.
So we have another question.
Hi guys. Oh gosh. My name is Sean Sandy and I'm from Memphis, and I built a consulting firm called The Selling Agency. So you can guess what I focus on, selling. And I build revenue engines for businesses who don't yet have sales strategy, sales program, and sales teams. And it's really interesting when I talk to startups, I hear a lot of language like, well, when people find us, when people try our demo, there's so much focus on the funding and pitching to VCs, but I really have not yet met one that has a sales strategy. When you're listening to people pitch you, how far down the path do you have to see a sales strategy before you invest in them? How important is that for them to show you how boots on the ground, sell, move product?
Immediately. You've heard always be closing. The idea that you've got a great product without a monetization strategy, to me, is such a death knell for at least my interest in sort of your business. And you don't have to be right, but you have to have a couple of ideas of how you're going to actually generate revenue as opposed to divert all of your attention and all of your focus as an entrepreneur into the product. Because what I see frequently are these very, very sophisticated solutions just like looking for a problem or waiting for the problem to come knock at their door. And I'm of the mindset that you build to a specific problem, and then you'll start to figure out your market, but you have to have people knocking on doors and calling people a lot. So monetization is key to me, and at least having a really proven theory on how you're going to monetize, if not sort of the best proof of monetization, which is revenue.
Hope is not a strategy.
I'd take a different take on that. I think monetization and selling are not necessarily the same thing. In fact, we've made multiple investments where we had companies that were monetizing where we told them to stop. And because they were in markets where the greater value would be created by market share or the size and breadth of the network they were creating, upon which they could charge and get more money down the line. An example is a company in Ann Arbor called Farm Logs, which we invested in. They're a Y Combinator graduate. They aggregate data both from farming operations as well as data from other sources like geospatial satellite imagery, soil data, weather data, et cetera. And they provide insights and will soon be providing, currently providing recommendations to farmers, what to do, where to do it, et cetera. And they were charging for that. And this is one of those businesses where the more farms you add to the network, the more data you get, and the more data you get, the more you have a value to sell down the line. So we shut off the paywall, and we now have a quarter of the U.S. Row crop industry acreage on the platform in a very quick period of time. We tripled that in a year because we turned off that paywall, and now we can do so much more as a result. Did we stop selling? Absolutely not. We just stopped charging.
So I have another question.
Thank you.
Yes, I have a question on geography. So my name is Zach. I'm from Louisville, Kentucky, and I've heard the metaphor that a lot of venture capital is like cement, in the sense that the farther away you get from the VCs or the VC firm, the more it dries up. And I appreciate your kind of, multi-geographic approach, and I also appreciate a focus on the Midwest as someone who grew up in the Midwest. But I wonder if you guys could speak to, the perceptions of what type of companies you can build in what type of markets. For example, people will say you're not going to build the next Facebook in Louisville, Kentucky, right? Which is not, to your point earlier, is not true. I mean, you could, but I think there's a lot of perceptions around that. So could you guys speak to either a lack of geographic focus when you're sending capital out, and or why you're focusing on specific geographies?
Most venture guys are lazy. They don't want to get on a plane to fly to you for board meetings because it interrupts their golf game, right? So what you need to do is, number one, you need to find great investors who don't care where you are. And the thing you need to have is you need to have a real good technology center of excellence. That's what it takes to build tech companies. So could you build the next Facebook in Louisville? Probably. You have a lot of great, academic institutions there. You could do it here in Nashville. You have Belmont, Middle Tennessee, Vandy, right here. They all have great engineering schools. It's a matter of keeping the engineers local, have a great IP department where you can actually get the IP out of these universities and build companies. So I would say that is the most important thing. And find venture guys who aren't afraid to get on a plane and don't have a scratch handicap, and you'll be in good shape.
Anybody else want to respond? Are we good? All right, next.
Hi, Hans Miller from Airside Mobile. We make Mobile Passport.
Get a little closer to the mic.
Sure. I'm Hans Miller from Airside Mobile. We make Mobile Passport. I had a question. You said that if the opportunity isn't big, don't bother talking to me. How big is big?
I mean, we have different size funds. So we're managing a $500 million active fund right now. We have about 2.2 under management. So for us to return $500 million fund, a deal needs to return somewhere between $70+ million in capital. Based on Trevor's numbers, you have to sit there, and I have to take that fund. In order to be an impressive fund, I have to return $1.5 billion on $500 million. So the types of industry that we're looking at are things like material science business, enterprise technology businesses that have the ability to win in a market that is greater than $4 or $5 billion. If it's not, it's really hard. For smaller funds, they have the ability to invest in smaller opportunities because they have a lower number of returned capital, right? So they can actually invest in things that have a market, a total market size of maybe 500 million if they think the company can take 30% of that market. So it really depends on the size. For us, we're looking at things like material sciences that are stretchable silicon that you put on your skin that people like L'Oreal are using to measure UV rays. It's a $7.5 billion market. And that's what we're talking about in size. So it depends on the size of the venture fund and how much capital that they have to return.
Actually, maybe I could address that.
Sure.
A couple of funds that are very interesting to look at are, say, True Ventures or First Round Capital, where they have decided, I think as pioneers in our industry, to do a larger number of investments in a given fund. And I remember talking to Josh Koppelman back when he was raising the first round capital fund, and his objective was to do 70 investments. Then John Callahan from True Ventures decided to morph his model to 50 and plus investments in a given fund. And what that allowed them to do was to generate high returns on smaller checks. So I think for those funds, and frankly also us, we're very happy to invest in companies that can generate a potential 10x return on a small amount of capital, right? $2 or $3 million. And again, we have a $166 million fund, and a typical fund will do 120 companies. So again, we're allowing the needs of the enterprise to dictate the check size. And if the upside is high, we don't need to have 200, 300, $500 million outcomes. And when you look at someone like True or First Round, it's uncanny. They're selling companies for 60 million, 80 million, $50 million, and they're making 8 times their money. So they're succeeding on the more capital efficient approach.
I think the key to keep in mind, and that everyone's saying here, is all VCs are not alike. They have different strategies, they have different return thresholds, they have different sector focuses. For example, we don't invest in life sciences companies, things that go in the body, pharmaceuticals, medical devices, things like that. Not because you can't make money in those industries, but because we don't have backgrounds, and we can't be helpful, useful investors in those types of companies. We don't know how to build them because we haven't done those before. So do your homework on the VCs you're approaching. There's certainly one that'll fit your business, but you need to be able to find them and understand what their objectives are.
And so we have time for one more question.
Great, thank you. Cordell Carter from Techtown in Chattanooga. My former employer, the Bill and Melinda Gates Foundation, was very active in the venture space through a program called the Program-Related Investments. And so they would invest in ed tech firms, just like you all invest in companies, but the return expected was social impact. So my question to you all as investors is, how do you compete with the price of zero?
And do you?
Or do you?
This is kind of like my Red Hat Linux experience, which is how do you sell free software? You don't. It's totally different. There's a fund called Radar out in the Bay Area, and they're a philanthropic fund. Their LPs understand that they're going to get returned capital, and any profit goes into philanthropic efforts. When you have LPs that are expecting a return, you really can't compete with zero because they're expecting a return on their invested capital.
The C in VC stands for capitalist, right? And so the essence of it is all generating lots of profit, is much maximizing profit. I mean, the idea that there are social funds, social impact investing, great for the world, but our investors don't expect us to necessarily, depending on the fund, but our investors aren't paying us to change the world. They're paying us to return their capital.
Great. Thank you.
And with that, thank you, gentlemen, for your time today. Appreciate it.
Thank you.
Thanks, Eric.
Thank you.
You guys. All right, wonderful. Thank you so much.